On the 5-minute chart we have a bounce on the 200 EMA, but if I squeeze the chart, that's the euro US dollar, we have a range in this area, which is not bad because price is trying to decide if it wants to go higher or lower. We have a touch on the 200, usually a touch on the 200 after a big move for the first time is a bounce, and we could just aggressively take that short. But you know that here is a wedge and the price is stuck in between. That would make the short aggressive. Yeah, it's not like it's a smooth like here, like before, a trend and the price is coming up and just bouncing. It is stuck in this area for the whole night Asian session. Now it's bouncing on the 200 EMA. Yeah, a trade here short would be aggressive, but the management would be like it was yesterday and the other day and the day before. We just didn't catch it live. So you trade short aggressively on the bounce, and if that's not working out, you close the position and wait for a long setup here to trade the retracement back to your 36 EMA. On the 1 hourly chart, at least, we have much space on the 4 hourly. You know that the pressure is down, and instead of waiting for a setup under your wedge, you go aggressively short after the close on that candle. So we should have done it already. I just have to explain it first. And because it's aggressive, you can take a smaller lot, risk only, I don't know, 0.2% on the whole account, and say, okay, let's do that. That we have support here. Can you see that? So much support and resistance at the same price. So going short here makes the whole thing aggressive. But what you do is you trade the bounce on the 200 EMA. That's a way to trade aggressively, a 200 EMA bounce. So what I do, I take 1.5 lots. We have a red candle already before that. I click on sell. Okay, now what we do, if for some reason this is not working out, we aggressively we close our position very, very fast. Okay, is everybody with me here? We had to do it fast. It was live, so we have to take advantage out of that. Okay, remember that is a really, really small position compared to the account, which started at 100,000, a risk of usually 0.2, 0.3, 0.5%, 1% if we are trading 3 lots looking for intraday setups. Okay, so a bounce on the 200, usually to make sure you're on the right side, you wait for the price to close. Usually it's a green candle if it's moving up. Then you wait for a red candle to close after it bounced on the 200. Now manually you would take out a position if you see the price going back up and breaking the 200. That means at about 10 pips or even less you would close half of your trade. Okay, manually. The initial stop would be over your point, over your highest point. In that case, that is your highest point. Somewhere here, include the spread, is your stop. In case everything goes wrong, you close out with 20 pips at the worst. Okay, that's the worst scenario. Now, of course, if the price is moving down and it's hitting our support down here with about 10 pips, what we are doing, we take out half of the position too. That means we go to here, 0.75 would be half of the trade, right? Profit, you would have closed it down here. So now I think it's going down to 10. Okay, we close half of it. If the broker would have been fast. These brokers people usually are very slow, so they can make some extra pips, but it's okay now. It's training only. Now you keep half of the position in. And now the same scenario, you know, if everything goes against you now, it will probably be a break-even trade, and that's about it. If it's going against you and you say, you know what, I leave my stop where it is and I get stopped out with 20 pips, in this case you have a loss of only 10 pips because you took out 10 before. Okay, 10 pips with a really small lot size. Now you'll see we risk like 7-8 pips manually, and maximum like 20. Price move down already 40 pips. So if you want to take out a little bit more, it's already twice your stop. What you could do is, okay, I'll take out another 50% of my remaining position, more or less, and leave now just a third in. Now that you have taken out about, I don't know, 35 and 10 pips, it's again win-win. You cannot lose any more even if you put your stop up over here. Now you don't have to do that anymore. That is the trend line you have left, and that's over here you can put the stop, and that would be like 5 pips lost. That means you keep almost everything, and that is 1.2582. There we go. So in case the market retraces back up in the wedge, you will probably try to find the 200 again, and then better get rid of the position, and probably maybe you can trade another bounce, okay, or a break. It's a round number here, and it's probably going to retrace. And okay, if you think it's too much pressure, then do something. Just take a little bit out, like 0.15, close that, and keep at least almost a third of your position in. Okay, you trail the stop, but you cannot trail the stop yet because you don't have a retracement yet. If you trail the stop right now to let's say here, and the retracement is going to be fast, for instance, sometimes it happens that the retracement is not going to do something like that, but it's moving up like this. And if you have the stop too close by over the 36 EMA, you get stopped out, and then it will go your way. So what we do to ensure that you don't get stopped out for nothing, you know that you are in a win-win situation, so you wait for your retracement back to the 36 EMA. And if the price is bouncing there and you see it's moving lower, you can take your stop from where it is now and trail it over your previous setup, or over your lower high. That is the highest point, that would be the next lower high.